Hey everyone, welcome back to Corporate Decoder, the place where we connect the dots between corporate filings and the real story behind the numbers. Today we've got Stone Point Credit Income Fund making an appearance, and let's just say they've been busy collecting some funds. First up, let's set the scene with who filed this. This is a report sent to the US Securities and Exchange Commission, or SEC for short. Think of them as the watchdogs of the stock market, making sure companies play fair with their investors. This particular document is an 8K report. This is like a company's way of sending out an urgent bulletin. If something big happens that shareholders need to know about right away, they file this. The big date here is the 21st of January 2026. This is when the earliest event we are talking about today actually took place. The company in question is Stone Point Credit Income Fund. As the name suggests, they're in the business of managing credit and income for investors. They're incorporated in Delaware. Now, why Delaware? That's a whole other story, but it is a common place for companies to set up shop for legal reasons. And here is a little tidbit: Stone Point Credit Income Fund is considered an emerging growth company. This means they get some special treatment under the rules for newer companies. Now, for the juicy part, this filing is all about the unregistered sale of equity securities. In plain English, this means they sold some of their company stock, but they did it without going through the usual public registration process. This is often done when a company is raising money from a select group of investors, not the general public. So what happened? Stone Point Credit Income Fund used something called a capital drawdown notice. Imagine investors promise to give the fund money when needed. This notice is them calling on that promise. On the 31st of December of 2025, they issued and sold a significant chunk of their common shares. We are talking over 2 million shares here. They sold these shares at their net asset value, or NAV for short. This basically means the price was based on the actual value of the fund's underlying assets at that moment. The price was $25.05 per S-share. All these shares added up to a cool $51 million. That's a lot of money being raised. Then there was another round of sales. This one started on the 1st of January 2026, and the final numbers were locked in on the 21st of January 2026. They sold another 215,768.463 shares. This second batch brought in another $5.4 million. So in total, Stone Point Credit Income Fund managed to raise over $56 million in these private placements. Why did they do it this way? They did this to avoid the lengthy and costly process of registering these shares. With the SEC, they managed this by using exemptions provided by securities laws. Specifically, they tapped into Section 4, Subsection 2 of the Securities Act and Rule 506 of Regulation D. These rules allow companies to raise money from a limited number of investors, typically sophisticated ones like wealthy individuals or institutions, without a full public offering. Crucially, they did not advertise this sale to the general public. This is a key requirement for using these exemptions. They weren't trying to sell to everyone, and a big part of this relies on the investors themselves. The fund made sure that everyone buying these shares was an accredited investor. This means they met certain income or net worth requirements, making them presumed to be financially savvy enough to understand the risks involved. And here we have the official sign-off. This report is signed by Stephen P. Henke, who is the Chief Financial Officer. This means he's the one officially confirming the accuracy of this filing. The report was formally dated the 22nd of January 2026, a day after the final share count. So what does this all mean for Stone Point Credit Income Fund? This filing shows a successful effort to raise significant capital through private placements. By using exemptions from public registration, they were able to quickly bring in over $56 million from a select group of investors. This is a common strategy for funds to quickly deploy capital and grow their operations without the red tape of a full IPO or public offering. The key risk here is that private placements are generally less transparent than public offerings, and investors need to be sophisticated enough to understand the risks. However, for a fund like Stone Point Credit Income Fund targeting specific investors who understand credit and income strategies, this seems like a very standard and effective way to fuel their business. It signals a clear intent to grow and likely take on more investments or expand their current portfolio. What do you think about these private placements and their impact on the fund? Let us know in the comments below. If you found this analysis helpful, give us a thumbs up and subscribe for more corporate disclosures decoded. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and well, see you in the next one.